This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Vincent's picture saying, looking for the downloads. Now, Eric, let's cover crude oil.
EIA inventory was delayed by the U.S. Veterans Day holiday this week, so we don't have any statistics for you. We got back down to the low end of the trading range to a 66 handle in the last couple of days, back up to mid-68 handle as I'm recording here early on Thursday morning. Given how boldly President-elect Trump's other policy moves have been, I don't rule out an extreme move or say some kind of deal with Mohammed bin Salman to manage prices lower, at least initially after taking office, in order to kind of prove himself to the American people as doing something Biden couldn't do. So I could see it going that way. I could also see a big escalation of geopolitical risk taking it the other way. Bottom line, I'm flat here. I don't see any attractive directional trades unless you have inside information that I don't have.
Well, Eric, I'm just going to give a simple technical assessment. The price action remains distributive. The primary downtrend is down. The descending trend lines are intact. Below all moving averages, all rallies fail. It's incredibly distributive and bearish price action. Now, we are trading at a key support line. Throughout September and October, the lows were established at this price level. And so we have a primary downtrend trading along a key support line. And those lows also were the lows that were established back in May of last year, including November and December of last year. So we're at a key price level where a lot of lows have come in. So if this level and the support line gives out, which is entirely possible, that would open the window for a decline down into the low 60s, down to even 62 or 60 on the downside. Now, I'm trying to give the bulls the benefit of the doubt that the support line will hold. But again, the primary trends are down. So if that support line gives out, another 10% decline in crude oil is entirely on the table. Now, let's move on to equities. What's your thoughts here?
The initial reaction to the election result was clearly positive, but now the rally has paused as markets absorb the news of just how extreme Trump's cabinet picks are going to be and what their stated intentions are about what they plan to do when they take office. So I really don't know what's going to come next here, but I think we need to watch carefully at the continuing news flow out of Team Trump and understand where they're planning to take this administration, and are they really intending to be as brutal as Elon and Vivek Ramaswamy seem to be talking.
Well, Eric, over the last month or so, we were so close to the 6,000 level. It was ultimately the election results that added the clarity and the tailwind for the market to make this burst to that round number of 6,000. There are measured moves that are up to 6,200 plus on the upside. So there is still room for this market to go higher here. The momentum is clearly in the bulls' favor, and there is zero sign of distribution. So one has to approach this with the assumption that the bulls are in control of this trend, and the momentum is in their favor, and follow through and flows are likely to support that, at least for the short term. My view is that at this stage, this market can easily continue in these prevailing trends of things that have been working, will continue to work right up until the U.S. Thanksgiving. At some point, all the flows and rotation that was happening to drive this will have fully played out, and the market will reach an exhaustion point. But there is zero sign that we've reached that level. So we have to respect these prevailing trends. The patterns of higher highs, higher lows, trend lines above all moving averages is still very much in play. And so we'll see where the exhaustion points come. But right now, I have to give the bulls the benefit of doubt, and we're going to see how far they can take this. Let's move on to the dollar index. So what are your thoughts here, Eric?
Well, the big news I was going to report on this week's podcast was, oh boy, the Dixie took out 106 to the upside. Can we get to 107 by next week? Well, just in the last few hours before I went to record, we're at 106.925 right now on the December contract. I'm going to call that close enough to call it a test of 107. Are we going to break through 107? Are we headed all the way back to 116, which was the prior cycle high? I don't know, but this is going to get interesting. Let's see where this market takes us.
The momentum doesn't quit. We're trading back to the 2023 highs, what's now been a 2-year trade range, and the momentum isn't even slowing. Now, we are literally trading at the time of recording here at the 107 level, which is essentially the highs of this range. I mean, with this kind of momentum, if the bulls can somehow miraculously break it out of this trade range, that opens a huge upside window. My initial thinking always is that these resistance levels should at least temporarily stall price action and act as some form of resistance. But the momentum has been so strong going into this. It'll be very interesting to see whether the bulls can break this out. On page 5, I have the Euro USD, and I put it on a weekly chart so we can really see this on the reciprocal of that dollar index. And you can see that breakdown in the euro is so distinct. We're right back down to the 105 level again, a 2-year low. And this is going to be a very important line in the sand. Either the euro can muster up a bounce off this level, or it will be the driver of a big US dollar breakout. This is clearly the currency cross, and therefore this is the one to watch. And this 105 level is just critical on this. And again, like I was saying to the dollar, this is a level where you should technically anticipate a bounce. It's so oversold on the euro, coming right into a very key support line. At least a reaction or a pause should happen here. And if it doesn't, it just will tell you how strong that momentum is, and certainly that could create some incredibly volatile events. Now let's move on to gold, where there's been that extraordinary move, and I'd love to get your thoughts on this.
There's no doubt in my mind that what's happening here is a rotation out of gold and into Bitcoin. And Bitcoin, for anyone who missed it, hit new all-time highs this week as gold dropped like a rock. I see the view that Vincent Deluard expressed in the feature interview, that Trump is just playing politics and paying lip service to what the crypto crowd wants to hear, as a distinct possibility. That might be the explanation here. It might be just telling them what they want to hear, and then back to business as usual. But the crypto community's pipe dream has always been to create a new money system that would compete with and then eventually displace government-issued money, democratizing money itself so that no government can control it. Now, the central thesis of my 2018 book, Beyond Blockchain, was that while that sounded great to libertarians, the reality of the situation was that major governments, that's the people with all the guns and the handcuffs, would never allow privately coined money, whether it be crypto or otherwise, to take away their monopoly on the issuance of money and the ability to control its supply through government-controlled monetary policy. That's where the most entrenched, powerful people that exist in the world gain their power, is from the ability to do things like control the money supply through monetary policy. But if ever there was a government that just might allow or even encourage the replacement of government-issued money with decentralized digital currency that no government has direct control over, well, it might be a government where Elon Musk and Vivek Ramaswamy were apparently just given the green light to fire more than half of the current government employees. Now remember, Elon is a big crypto fan, and one of his favorite cryptocurrencies seems to be Dogecoin. Is it a coincidence that the new Department of Government Efficiency has the same name as Elon's favorite cryptocurrency? Now, to be clear, I don't think that President Trump has any idea what the implications are of encouraging widespread cryptocurrency adoption as a sanctioned alternative to government-issued money. One of President Trump's other objectives that he's been very emphatic about is he says that we absolutely need to safeguard the U.S. dollar's role as the global reserve currency. I don't think President Trump understands that those two goals are diametrically opposed. but the people he's putting in on his cabinet seem like the kind of people who might just favor such a move. As I said earlier, I don't think President Trump's bold new agenda of firing half the government and going to all-out war with the establishment wings of both parties is going to see anything but the strongest possible resistance and opposition from most of the government. And I don't rule out the possibility that Mr. Trump will never be sworn in for a second term, despite his landslide victory in the election. The stakes have never been higher for the entrenched powers in Washington, so their response will be equally forceful and dramatic. Coming back to gold, if we saw a government-sanctioned popularization of Bitcoin, it could be very, very bearish for gold, at least initially. Now, central banks around the world would continue to favor gold rather than Bitcoin, but the price trends in gold and Bitcoin since the election speak for themselves. And if the Bitcoin momentum continues beyond $100,000, that could easily cause the last gold bug standing to eat their losses and chase the Bitcoin train instead. Moving on to the technicals in gold. Just before the European markets opened on Thursday morning, we were sitting right on the 100-day moving average at 2560. That's 2560, which was also the 21-week moving average. And to my eye, it's kind of a make or break line, an important one. 2600 should have been trend line support, and that should have been good at least for a significant bounce, but the market just went through it like it was melted butter. So, and that's a trend line that's been in place since last February. We didn't even get a bounce there. So if you're feeling lucky, right here as we're dipping now after Europe opened, we dipped all the way down to just over 2540. I think the number is 2542 is the lowest print I see on my screen as I'm recording about an hour and a half after the European Open, 5:30 on Thursday morning. It looks like we're down at 2542 is the low. If you're feeling lucky, that was your dip below the 100-day. We'll close above the 100-day by the time Thursday is over because, boy, that's such a clear line in the sand. It's got to hold. Well, if it doesn't hold, then there's probably some Fibonacci support around 2,500 to 2,520. If 2,500 even doesn't hold, I think it's a fast ride down to 2,400 at the 200-day moving average. And if that doesn't hold, anything's possible after that. The reason I'm going out of my way to intentionally mention these targets that are hundreds of dollars below the market is I think that if there is a government change of attitude where all of a sudden cryptocurrency is welcome and, the Trump administration is issuing executive orders saying, we're going to be nice to the crypto community and we're going to have a strategic Bitcoin reserve and so forth. If they really followed through on those things, I think it could be really, really damaging to gold. Bottom line, there's more uncertainty in this market than anything else. I certainly regret not following my own instinct. I said here on MacroVoices 2 weeks before the election, I don't understand why everybody is so bullish on gold if Trump wins. I think you could make the opposite argument more persuasively. I said that, but I didn't hedge my position nearly as much as I should have, and it's been a painful ride down. In any case, I'll be watching what happens here at the 100-day moving average. As I'm recording, we're still below it. A close above before the end of the day on Thursday would be a refreshing symbol that maybe we're going to put a bottom in here. If it keeps going south from here, I think we really need to be careful in terms of what comes next.
Eric, I'm just trying to keep this far more simple. You look back to the pre-election gold price, the sentiment was so bullish. Everybody was in clear consensus. Gold could do no wrong and only had upside. It was a lopsided trade that was due for some sort of a correction to shake out weak hands and the over-leveraged traders. So with this short-term high, we've now 50% retraced the rally since the summer. And giving back half of the gains is actually a typical retracement. But now we are actually at a very key line in the sand. The August-September consolidation that happened in this 2,500 area that was at the time a key high is now going to act as potentially support. The key Fibonacci retracement level is right at this 2,500 level. And so this is a very logical place for the short-term downtrend to at least pause. And and offer a reaction, something that could easily bounce $100+ an ounce off of these support lines. Will it? And that's the big question. I mean, so, you can see the dollars at these extreme levels. So many of these markets are at these extreme points. And it feels very much like either all of them are going to react or none of them are. And if none of them are, if these prevailing trends keep accelerating, at some point it's going to become a market disruptor. And so right now we're at a critical support. Let's see if it holds in this next $50. Now, moving on, Eric, I wanted to just touch on page 7 on the copper price. Now, copper was trading along its 50-day moving average, right along a retracement zone, a logical place that if there was going to be a bull continuation pattern, it would have acted like a key support around that 4.25 area. And this week, that the feet just got cut out from underneath the copper bulls. And when that key support level was given out, it was like a drop straight down right to the August lows. This is now re-engaging a prevailing downtrend that was in place from May till the summer. Now, we are approaching the August low, which often can offer a support. But if we see that the bulls don't rebound this in any meaningful way, we may find ourselves right back into the 2023, 2024 trade ranges, which were in that kind of $3.75 to $4 area. And so there could be still further downside in going into the tail end of this year. Now, Eric, let's move on to uranium. What are your thoughts here?
A huge amount of bullish news flow came out in the sector this week. 6 more signatory countries signed on to the Triple Nuclear Pledge. Now, this started at the COP28 conference in Dubai last year, where 22 nations initially signed on to triple nuclear energy globally by 2050. 6 more countries signed on at the COP29 conference that was just held this week. So I see this as really important because we're seeing more and more government consensus around nuclear being the solution to climate change, which has been a lot of government's obsession. What they need to figure out next, and I'm doing everything I can to try to get audiences with them, is to recognize that government absolutely needs to get involved in clearing the way for the adoption of advanced nuclear technologies. We've got to ditch these light water reactor antiques, which is still the technology everybody's using because of government bureaucracy being unready to regulate much newer and better designs. And when I'm talking about much newer, I'm saying we got to ditch the 1950s nuclear technology in favor of much, much better stuff like late 1960s technology. These problems in nuclear engineering were solved a long time ago. We never adopted them because the governments around the world have been standing in the way of progress. It's time to recognize that the solution to climate change and energy transition is to fast track the adoption of advanced nuclear technologies. I think that this continued support of the Triple Nuclear Pledge and more countries signing on is paving the way for some countries around the world to finally stand up to the United States and say, Section 123 has to go. It's time to get serious about advancing nuclear technology and not staying stuck on 1950s technology. Sorry for the editorial there, folks, but I really think this is important to the future of humanity. Next news item, NVIDIA, that's the AI guys. They've made some kind of deal with the Diablo Canyon nuclear facility, which was scheduled for shutdown. They're resurrecting it. Now, nuclear facilities have to be air-gapped for security reasons to protect them from terrorism and so forth. NVIDIA wants to put their AI inside the nuclear power plant, so it's not air-gapped. They won't be on the internet, but they will be AI operating inside an old-school 1950s technology nuclear plant. I don't quite understand what the angle is there, but certainly big nuclear announcements are coming out every day now. Tripling nuclear is going to require a 10x on enrichment capacity, according to Orano, one of the biggest enriching and reprocessing operators, a French company. We don't have it. Most of the enrichment capability is in Russia and Kazakhstan. There's a huge need to build it here, and there's a huge opportunity to build more. The state of Kentucky just announced a new development authority to plan how Kentucky is going to adopt nuclear. Yet despite all of this massively bullish news flow, F3 Uranium, which is a terrific exploration play, great stock, and I don't know of any significant adverse news to explain it, just retested the September 6th lows at I don't know if it got 20 even, but it was 20 and a half cents. I bought a bunch more this morning at 21 cents. That's a fantastic deal. It's the only stock I see that's really retraced that September 6th low, and it's a strong buy here. So why are we seeing these bargains in uranium miners, especially an exploration play, which is a more speculative play about the future as opposed to current cash flow, when there's so much news telling us that uranium demand will be increasing in coming years? Fundamentals couldn't be stronger, and we're seeing buying opportunities anyway. Why are we seeing them? Because there seems to be a buyer's strike in the physical market. The utilities are holding out, delaying their purchases or something, hoping they're going to get a big trend reversal. I don't think they're going to. The fundamentals are too strong. I think that there's going to be a holdout and wait tug of war, and I think the utilities are going to lose and that uranium prices will eventually move sharply higher. Right now, though, there seems to be a buyer's strike, and in my opinion, that's what's holding back a big move higher in uranium-related issues. We are seeing a few of them really take off. Things like NewScale, ticker SMR. Oh boy, after going public around $10, they were down to $2. They're almost 26 this morning. So some of those nuclear startups are really taking off. Uranium will catch up as soon as the spot market catches up. And I think that's just a matter of resolving this buyer's strike.
Well, the story in the post-election period is about the things that are working versus the things that are left behind and or just treading water. And initially, I thought that uranium might get some tailwind in that post-election period, but that's clearly not been the case. At this stage, this is a market that has been relatively inactive and ignored on the short term. Now, obviously, uranium equities have done much better, but when we're talking about spot prices, uranium and the uranium trust and other things like this, it really hasn't gotten any flows. And so it'll be really interesting to see whether this support line holds. It's a very logical area for uranium, the U308, to kind of settle at these prices. But bottom line, there isn't any prevailing trends here. And I would assume, at least on the short term, that this will continue as most of the money flow going around is just chasing what has been working. Finally, Eric, I just wanted to touch on the Bitcoin chart. I don't have too much technically to say beyond the fact that it's been an extraordinary breakout. I mean, we had a huge bull run between 2023 and the first quarter of 2024. It went from like 70 plus thousand. And then we went through what was basically a 6-month dead zone trade range. And clearly, this Republican administration has woken this up. Now, if we look at the rules of symmetry and use that as projecting tools, this does measure all the way to 100,000, and that's been a huge psychological level that a lot of the crypto community has been targeting. Now, this move to 90 plus thousand has happened a little too quickly, and so there's always room for things to pause and consolidate, but you have to give the bulls the benefit of the doubt that even if we did see a $2 to $5 or even $10,000 dip, it will be bought on dip, and the primary trend will be up. Will we get that deep of a dip, like a test back toward a 50-day moving average as it's approaching higher? At some point, the rally will get checked. But at this stage, some new life has been put into this, and assuming that this is already over is too premature. At this stage, measured moves are up to 100,000, and let's see whether the bulls can pull it off.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.